We're now joined by PwC's Ketan Dalal and also EY Sudhir Kapadia and Dinesh Kanabar of Dhruva Advisors. Gentlemen, appreciate you joining us. Mr. Kanabar, if I could start by asking you, there are two different stories that we're dealing with here. One, of course, are the recommendations of the Justice Easwar panel, which have been submitted to the government, which talk about some sort of relief on the personal income tax front. The highlight, or the sum and substance, if I could call it that, is in a sense bringing back standard deduction, doing away with these smaller deductions which the Easwar Committee doesn't believe serve the purpose. Your first reaction to that story, and then I'll talk to you about the story that Timsy just broke.
So the Easwar Committee, just as a background, had given a set of recommendations last October, that is not the October ruined by the October before that, and bulk of those recommendations got incorporated in the last budget. In fact, it was heartening to see that the government was following heed to an expert committee which it had appointed, and most of the suggestions were very, very positive, including the fact that when you are in litigation in tax, you only end up paying 15% tax and the balance would be kept in abeyance. And therefore, my expectation is that the recommendations which the Easwar Committee would have now given, which are, as I see, not in the public domain at this point of time, would be very much accepted by the government and implemented, number one. Number two, the Easwar Committee went around the country, had extensive consultations with various stakeholders, chambers of commerce, etc. And to the best of my knowledge, had made very, very sweeping recommendations, both in the context of domestic taxation, individual taxation, and taxation of corporates. A recommendation like, for example, doing away with imputed income on house property is something which is, in a sense, not something which is going to lead to a lot of revenue leakage, but very, very welcome. And we'll do away with some of those issues which small taxpayers are facing. Very, very welcome.
Okay. Mr. Kapadia, if I could ask you, as you know, this is of course source-based information, but we are given to understand that the panel has recommended changes in the transfer policy law to also reduce litigation for global investors and in an effort to promote Make in India. These are some of the recommendations, further changes in the capital gains tax for various instruments. You know, on the back of what you've heard so far, sir, what would your expectations be and what could the implications be, more importantly?
Well, as I see it, the transfer pricing point of the Easwar Committee would probably refer to one area which has been bothering foreign investors, particularly in the shared services space. So we have a safe harbor rule which has provided for a certain basis of cost plus revenues to be made by captives in India, which frankly has prescribed, historically prescribed a very high number, going right up to cost plus 30% for certain activities. It is because of this very impractical safe harbor rule that we had this plethora of cases going to the APA for transfer pricing agreements to be entered into in advance. So I think what has been recommended by the Easwar Committee on the basis of what representations in turn have been made to the committee is that we must have a change to the safe harbor rules. And what is that change? The change is not to give any concession. The change is to recognize the fact that if India has to now attract, and we have to go up the value chain in terms of these shared services and attract more machine learning, more artificial intelligence kind of activities in the services in India rather than take them away elsewhere, then because of the fact that we have better talent employed in these shared service centers, the cost plus should not shoot up to 30% and 40%. If this is what has been recommended and if the government accepts it, it will be a tremendous game changer and very, very good to know that this is coming.
Okay. Let me also bring in Ketan Dalal into the conversation. Mr. Dalal, on the controversial issue of the ICDS, you know, there was a lot of murmuring on whether the government would, in fact, accept the recommendations of the Easwar Committee. We are given to understand that the Easwar Committee has pointed out some drawbacks with the ICDS and what it could mean as far as corporate India is concerned, but the government likely to continue and go ahead with the ICDS. What would your take be on that?
Shereen, I think ICDS is completely misconceived. ICDS, for the benefit of your viewers, stands for Income Computation and Disclosure Standards. Now, if accounting standards, you have accounting standards, now you have something called Ind AS, which is aligning accounting standards with global accounting standards. If accounting standards do not reflect the profit, then pray, what does? And if you don't have to pay tax on that, then what do you pay tax on? And where is the question of having a completely separate set of standards? So, for example, ICDS was tinkering, for example, with the method of valuation of stock, the point of time of revenue recognition. Many of those items were, Shereen, in the nature of accelerating the point of time of taxation, creating an enormous amount of needless confusion and completely contrary to simplification and ease of doing business. And strong recommendations, and I'm aware of those recommendations, strong recommendations have been made, including to the Easwar Committee, for them to make the recommendation and, of course, to the government separately as well, that there cannot be anything like an ICDS. And there have been, of course, some reports earlier today in the press that the Easwar Committee has recommended scrapping. So, of course, we'll have to wait for the report. But I, for one, think that if that is the recommendation, it's a very welcome recommendation and can remove. I don't think it's simplification. It's avoiding something which would have needlessly created complications in the first place. It never had any.
Well, that's not the sense that we get from the government just yet on the ICDS, unfortunately, Mr. Dalal. But let's see. We still have at least a few weeks before the budget. But let me bring back Mr. Kanabar into the conversation on the second story, and that is hopefully a clarification that will ease the confusion and the fear that CBDT circular on FPIs has led to. Mr. Kanabar, what we are given to understand that there is a different point of view in the economic policy wing of North Block as well as the revenue department. If the economic policy wing's point of view were to prevail, then perhaps there could be some relief coming in for FPIs from that CBDT circular that was issued on the 21st. What would your expectation be? Because, we understand that the process of representation has been underway for a week or so.
So, Shereen, first of all, we had a retrospective amendment which caused its own furore, number one. Number two, thereafter, the retrospective amendment was in respect of Vodafone-like transactions, was never really intended to cover situations like FPI, portfolio investment, and things like that. The circular which came out, to my mind, was the most unfortunate circular that I have seen CBDT issue in recent times, where actually you re-emphasize that people who should not otherwise be covered by the provisions are indeed covered. And the representations were really needed, and I'm glad that the representations are being heeded. So at one level, I would say that the circular is absolute reflection of what the law reads. There is no doubt on it. So in that sense, the circular was not incorrect. But was it the law that was intended to be? I think that's the real proposition. And a relook at that and really, so if, for example, you have a feeder fund who's made an investment into India, redeems its units, and the money goes back to the parent fund, can there ever be a taxation? It could never have been envisaged. And therefore, to read the law literally and try to tax FPIs on situations like that was indeed not warranted. So literal reading, the circular was right. It was not ever intended when the amendment was brought, and I do hope that it is reconsidered, and if the law is amended to that effect.
Okay. Mr. Kapadia, I would imagine that you would echo what Mr. Kanabar has to say, but in specifics, what would you like to see by way of the clarification? We are given to understand that perhaps we could see some sort of clarification next week on this matter. What would you like to see that clarification say?
Well, actually, Shereen, I think the Revenue Department is also on the same page as the Department of Economic Affairs after understanding the actual ground realities which were explained to them. And I think the proposition is very simple. The indirect transfer rules to be applicable to a shareholder who has more than 5% direct or indirect holding sitting anywhere in the world and to be subject to tax in India is frankly quite preposterous. And I don't think it was ever intended. The circular technically is not wrong, but when it was pointed out that these are the unintended consequences of just reiterating what the letter of the law is, I personally think actually there is no difference of opinion between the Department of Economic Affairs and the Department of Revenue, and I am very, very hopeful and quite confident that the requisite clarification will actually come, as you suggest, from the Ministry of Finance.
Okay, that's good to hear. You believe that post the representations, what were, the issues that were raised have now been at least taken into cognizance by both the Revenue Department as well as the Economic Affairs Department. Mr. Dalal, to you as well, in order to deal with the unintended consequences of that circular now, if the government were to provide clarity to foreign investors who are very, we've been speaking with a bunch of them off record and on record, and they've really called this the enemy number one, so to speak, of investing in India today.
Yeah, I think, as Dinesh mentioned, Shereen, this was never intended to be attracted with a 5% threshold. Let me illustrate this by an example. Let's say, and let me do the converse, that if you are to hold shares of a mutual fund in India, which has invested in US, say Franklin US Opportunities Fund, for example, and let's say the assets under management is 500 crores, and let's say there is an investor who holds 6%, which is, in my example, let's say 30 crores or just above that. When he transfers these units in India to somebody, would he even think that he will be exposed to US taxation? I don't think so. If that is not so, and I don't think that is so, then the converse should equally apply. And I think this was never intended to apply to situations like that. The threshold can never have been 5%. When you talk of indirect transfer, what are you talking of? You're saying that there is somebody who holds a significant economic interest in India, and he is transferring something offshore which leads to a transfer here. If you transfer 5% or 5.5% abroad, are you really transferring the economic entity? Are you transferring voting rights or control or anything like that in India? Of course not. And therefore, I think it was never intended to apply. And I think the sooner this matter is put to bed, the better it is, because this kind of uncertainty is obviously not helping foreign investments and is making them all jittery, as you mentioned.
Okay, gentlemen, I just have one small point of clarification to make, and this arose from certain conversations I was having earlier. Mr. Kanabar, in your interpretation, this CBDT circular that we are talking about, while we are talking about India-dedicated offshore funds, will it also take actual P-note owners under its ambit? In which case, would there be a case of double taxation if we are talking about, or maybe, higher taxation with respect to the actual holder of the P-note?
So the P-note taxation is actually a separate subject in itself. And while I would agree with you that it could lead to a triple taxation, but P-note issue really is that, let's assume that a particular fund has got five P-note holders and somebody wants to exit. When the shares are sold, there is no way in which one can do a specific allocation. The law provides for a last in, first out sort of a situation. Meaning that in the case of P-note holders, the way a fund would be taxed would be very different from what is the actual tax implication in the hands of the P-note holder. And therefore, it's actually quite absurd all the way. That's number one. And number two, yes, I would agree with you that you could have a triple stage situation where one is taxing the gains in India, and if those are exempt, one is taxing the overseas redemption, and if those redemption goes to a P-note holder, there could be a separate set of consequences altogether.
Mr. Kapadia, sir, a quick question to you. I mean, again, your thoughts on the interpretation, whether right now with the circular in its current form, whether P-note holders get hit or not, that's one point. And the second point on the 5% carve-out, because circular clearly says that those holding less than 5% of the total voting power or share capital or interest in the company. But the interpretation here seems to be, at least by the FBI community, that as an investor, if I am contributing to more than 5% of the total corpus, the assets under management, then I will be subject to taxation under these provisions. Is that the right reading?
Yes, that's how it reads currently, and that is the reason why one of the very strong suggestions was made is that you cannot have such a low threshold of 5% to determine indirect economic interest in a business in India. At the minimum, which should be 26%, which is in most common law countries considered as a controlling interest. the whole confusion arises, the whole uncertainty arises because you have kept such a low threshold, which can be easily, and just pause here for a moment. Look at sovereign wealth funds. Look at education endowments. Look at pension funds. These are the kind of institutional monies which we need and quality money which we need. Now, if they have a corpus which allows them to invest, let us say 7.5%, indirectly in an India dedicated fund, why should it be a minded? This is not a tax exemption you are giving them. You're just avoiding unnecessary double and potentially more than double taxation. Whatever is the tax you will collect by way of sale of shares in India under the prevailing capital gains tax rules, you will anyway collect. So in fact, we should encourage investments by such institutions, and there is certainly a very, very strong case to increase this threshold of 5%, which is, as I said, too low even in the case of these very large institutional investors.
Well, gentlemen, perhaps some of those issues that you've just raised will be addressed when the CBDT issues a clarification, which we understand it is likely to do next week. But remember, as we've been pointing out, this is perhaps the single biggest worry. People are not really concerned that much about the budget as they are concerned about the government addressing this particular issue. And perhaps we could see some of these issues being taken up and clarified on as early as next week. Mr. Kanabar, Mr. Kapadia and Mr. Dalal, appreciate you joining us here on CNBC TV 18. We'll check in with you, sir, as and when that clarification does, of course, hit the screens.